Now that you have a clear understanding of expected return and the concept of diversification, we want to focus on the concept of systematic risk. And our goal in this module is to formalize the relationship between risk and return. In economics and finance, when we say formalize, that means we want to have an equation that says if your risk is X, then your required return should be Y. And we're going to go through how we get to that equation. So first, let's take a review on the systematic risk principle. As we started at the very beginning of this module, we said there's a reward for taking risk. If we ask someone to take a higher risk, we will have to reward that person. However, there is no reward for taking unnecessary risk. So how do we define risks that are necessary versus unnecessary? This is where the systematic risk principle comes in. Remember, when we went through the systematic risk discussion, we saw that some of the risk will always remain no matter how much we diversify. However, some risk can be eliminated through diversification. So if someone chooses to put all their money in a single stock and therefore take a very high total risk, part of that risk is not necessary because that person could easily put his money in multiple baskets and diversify and eliminate part of that risk. So the risks that we consider unnecessary are the risks that are diversifiable. So investors should not be rewarded for putting all of your money in one basket. They should be rewarded for taking the risk that cannot be diversified away. They should be rewarded for taking the systematic risk that will always remain as long as they invest in the economy. So therefore, the relationship that we focus on is the relationship that is based on just the systematic portion. So we want to see what is the expected return given a certain amount of systematic risk. So in order to do that, our next task is going to focus on how do we measure systematic risk. We measure systematic risk by running regression analysis. And we will not go over how to do regression analysis in this class. All of you will take a statistics class or have taken a statistics class or a quantitative methods class where they focus on regression analysis. What we are going to do here is remind you that when you run those regression analysis, you will compute you will get the results for computing systematic risk. So the reason, in fact, one of the names for systematic risk is beta is because beta is oftentimes the term that we use to describe the slope coefficient. So beta here is the coefficient of the slope of the regression analysis. So when you run a regression and you come up with a slope coefficient, that is the beta coefficient. So the beta coefficient is the systematic risk of a particular stock. So since beta is the main measure of risk, it helps for us to standardize it. So a lot of times when we write beta, we signify it with the symbol B. So the beta of a stock, if a stock, let's say stock I, any stock, this is the systematic risk of that stock. So if we say a stock has a beta of, say, 1.2, what does that mean? So that's what we try to address with the next set of concepts. So it makes sense to have some form of standardization. So what we do is we standardize a very special beta, and that is the risk. So this is the beta of the market. We said that the beta of the market, let's make that 1. So that's basically a basic unit. So if we let the beta of the market equal to 1, that means any stock that has a beta of 1 will have the same risk as the market. So you think of that as a standardization. So 1 is the same as the market. And we have spent in the past chapter learning about the history of the market. So we know that in general, the stock market has a return of about 12%, 12 to 12.5%, and a standard deviation about 19 to 20% per year. So as long as we know how risky the market is, and most of us can have a general concept of the market, we can then compare the risk of every stock relative to the market. So if a stock has a beta less than 1, then we consider the stock to have a less risk than the market. And if the stock has a beta greater than 1, then the stock has a higher risk than the market. So now we can answer our question. If a particular stock has a beta of 1.2, that tells us that this stock has a higher risk than the market. Another way to look at this is through a graph. So in this graph, we have the expected return of a stock and also the systematic risk or the beta of a stock. So this graph shows a few things. So it shows the return and the risk of a different stock. So let's say stock A. Stock A has a return of 20%, and stock A has a systematic risk of beta of 1.6. So this represents the position of stock A on this graph. We have another investment, it's called risk-free investment. So the risk-free investment by definition has no risk. So because it has no risk, its beta, which is systematic risk, will be 0. And this risk-free investment has a return of 8%. So in this particular example, we have two investments, a risk-free investment that has a return of 8%, and stock A that has a risk of 1.6, systematic risk of 1.6, and an expected return of 20%. Now, if we look at other stocks, say stock B, and we put this on, and we put that on a graph, and we look at stock C, and we put that on a graph, and if we saw that there is a continuous line, that means this is a linear relationship, meaning that and this is an upward sloping line that shows the relationship between risk and return. We have, in this particular picture, we see that as risk goes up, so does return. So this is our original hypothesis, that higher risk will lead to higher return. So in here, beta represents the slope coefficient. So 1.6 is our slope coefficient. So what is the slope? So this may require you to go back to old high school math. So the slope is the rise over run. So we can find out what the slope is. So if you think about the slope, think about what this is. The slope is rise over 1. So the slope over here, the rise is the expected return on stock A minus the risk-free rate. So this part is the expected return on stock A minus the risk-free rate. So in other words, this is the risk premium. Remember, this is we learned early on, this is defined as the risk premium. The risk premium is the rise, and the run is the beta of the stock. So the slope is the rise over run. It tells us how much risk premium we are earning per unit of risk that we are taking. So this is the formal relationship that we can express in formal relationship between risk and return. In here, we show that in a graph. Let's take a look at another example. Another way to look at the slope is we call it the reward to risk ratio, because we take the risk premium, which is the reward, divided by the risk, which is the systematic risk. So this is a very important concept, because the risk to reward ratio tells us that this is how much we are getting paid as an investor for taking on risk. So in our example, the expected return on the stock was 20%, and the risk was 8%, and the systematic risk was 1.6. So the reward to risk ratio in our particular example is 20% minus 8% divided by 1.6. So it has a reward to risk ratio of 7.5%. What that tells us is that every unit, so every one systematic risk, investors demand a 7.5% in return. So we saw the example of what the risk and return or reward to risk is for a single stock. Now let's take a step back and ask the question, how would the reward to risk ratio be for all the stocks in the market? And what will happen when the market is in equilibrium? So if you think about the reward to risk ratio, that is, you can think of that also as the price of risk. So if I can get 7.5% per unit of risk by buying stock A, and I can get a higher return per unit of risk by buying stock B, everybody will want to get in stock B because it gives you a higher return for the same amount of risk. So by creating the reward to risk ratio, it makes comparison very, very easy across stocks. And when it's so easy to compare stock to stock, then the market forces will drive the stock market into an equilibrium. And remember that in equilibrium, supply is equal demand, and also the law of one price. If you're selling, for example, Coca-Cola, if the store down in the street is selling it for $1 and you're selling it for $2, everybody will go to the store that sells it for $1. So in equilibrium, you'll find that most stores sell Coca-Cola at around the same price. The same is true for stocks. When it's so easy to compare the reward to risk ratio from stock to stock, in equilibrium, we expect that all the stocks will have approximately the same reward to risk ratio. And that includes the market itself as a whole. So what does that mean? Let's put that into more concrete terms. So what that means is this is the reward to risk ratio. So let's say this is the reward to risk ratio for stock A. That has to equal to the reward to risk ratio for stock B, for stock C, as well as for the stock market. So this is the basic relationship. This is a market equilibrium condition. Now remember that the beta for the market has a very special property. The beta for the market always equals to 1 because that's the standardization. So what that means is this denominator is 1. So something divided by 1 is simply by itself. So next we can rearrange this. We can multiply the beta of stock A on both sides. So this will cancel out. Next, we're going to add the risk-free rate to both sides. And so this also cancels out. And the only term left is the expected return on stock A. So this tells us the expected return on a stock, and that's equal to, let's pick this term in better order. So we have the risk-free rate, and we'll add to that the systematic risk of stock A, times, here we have the expected return on the market, minus the risk-free rate. So this part, so we now have a formal formula. And remember that this last part is called the market risk premium. This final equation has a special name. It's called the capital asset pricing model, or CAPM. The capital asset pricing model tells us the relationship between risk and return. So here is the risk of the stock. So the risk of the stock is the beta. Depending on the risk of the stock and the market risk premium, this is the reward that investors demand to get from investing in the market as a whole. So if your stock has the same risk as the market, so this will be 1, you'll earn an expected return equal to the market. If your stock has a risk higher than the market, then you will earn a return higher than the market. And the amount that you earn, the extra amount that you earn, depends solely on the risk of your individual stock. So this is a really powerful equations and a powerful concept. It allows us to then assign expected return based on the risk of the investment itself. So now that you understand the relationship between risk and return and how we come to this equation, there's another way to look at this relationship, and that is through a graph. This graph is called the security market line. So SML stands for security market line. The security market line shows the expected return on one side and the systematic risk on the other side. So this is very similar to the graph that we have seen earlier. In this graph, we know that the systematic risk for the market is 1, and the expected return on the market is the current market, what the overall stock market's future return will be. So how do we know whether or not this model is correct? So it intuitively, that's what we hypothesize the relationship between risk and return should be. And the way that we test whether or not this model is correct is by looking at a lot of stocks in the stock market. And then we run a regression to see if they follow this relationship. So if the model is correct, then every single stock we observe in the market will fall exactly on this line. If a stock doesn't fall on this line and the model is correct, then you may have found something very unexpected. So if you find a stock, let's say, that lies here, that means this stock earns a higher return, so its return is higher than the rest of the stock in the market for the same amount of risk. So anytime you saw a stock that falls on above the security market line, this stock earns an abnormal positive return. And if you find a stock who falls below the security market line, this stock earns an abnormal negative return. Now, if the model is correct and the market is in equilibrium, that should not happen. So you say if the market is in equilibrium, all the stocks will lie on the line, and the slope of the security market line should exactly equal to the market risk premium. And most finance research in the past 30 years was devoted to analyzing whether or not the capital asset pricing model is valid. Assuming that the capital asset pricing model is valid, it really simplifies how we understand the relationship between risk and return. If you look at the capital asset pricing model, the model has the following equation. It says that the return on any stock is equal to the risk-free rate plus the systematic risk of the stock times the market risk premium, which is the return on the market minus the risk-free rate. So in other words, it has a few components. The first component that affects the risk of the stock is the risk-free rate. So this is the pure time value of money. No matter how much risk you take, or even no risk, you will demand at least earning the risk-free rate. And then the second is the reward for taking risk. And the reward for taking risk is the market risk premium. So it's this entire factor here. And then the last component is the amount of risk. The amount of risk is the beta of the stock. So the amount of risk is measured by the beta of the stock. So here are the three factors that affect the return on the stock. Lastly, I want to touch upon whether or not CAPM is valid. And the answer is there are a lot of debate on whether or not CAPM is the definitive model to describe the relationship between risk and return. The short answer to that is there has been a lot of study, and they find that there are more than one risk factor. So in other words, the market risk premium does not capture all the systematic risks. So there are more than one factors that contributes to systematic risk. The good news is that the basic principle we have studied is the same. So if you have more than one risk factor, what that means is we have to extend this model to have another beta and another risk factor. So you just make this equation longer, but it doesn't change the underlying principle. So what you're learning here is still very relevant. If we find out that there are more risk factor, we just keep extending this equation to include those additional risk factor. In this class and in this chapter, we are going to assume that there's a single risk factor, but with the understanding that we can always modify this CAPM equation to incorporate more risk factor as they become relevant.